Welcome back to the Neuro Finance Masterclass.
We're on day 52 of our 365 Days to Financial Freedom series. Now, if you caught yesterday's explainer, you know we spent a lot of time hunting for what we call asymmetric risk. We dug into the mechanics of finding those rare, high-upside plays where you can risk just $1 to potentially make 10.
Right, and it's a thrilling concept. But here is the cold, clinical, undeniable truth of the financial markets. Finding a great investment idea is really only half the battle. Honestly, it might even be the easy half. Today, we're transitioning away from the thrill of the hunt. We're stepping right into the clinical math of deploying capital because we are going to master the exact science of surviving the markets. Okay, let's dive into this, because understanding asymmetric risk means absolutely nothing if you don't know how to protect yourself when a trade goes south. And let's be clinically precise about this. They will go against you.
Exactly. Finding a phenomenal company or some highly promising token is just utterly useless if a single bad outcome can wipe out your entire portfolio. A professional architect doesn't just build a house for sunny days, right? They design the whole structure to withstand the Category 5 hurricane.
To really grasp this, we have to look at the stark contrast between the amateur mindset and the professional one. Amateurs typically operate entirely from a place of greed. They spot a great stock, and they're instantly consumed by one question: how much money can I make? So to maximize those potential winnings, they'll recklessly throw 50, maybe even 100% of their net worth into one single asset.
Right, whereas professionals operate from a place of calculated defense. A true pro is almost completely focused on protecting their capital first. Their initial question is always, how much could I lose here, and how do I ensure I survive if I do?
Which perfectly sets up rule number 1, the gambler's ruin, a mathematical certainty. That amateur behavior we were just talking about, betting the farm on a single good idea, it triggers a very clinical, unfeeling law of the universe. If you play a game long enough and you bet your entire bankroll every single time, a total loss isn't just a possibility. It is an absolute inevitability. Even if you have a massive statistical edge, variance guarantees you'll hit a losing streak eventually. And if you've bet everything, that one streak ends the game forever.
It ends it because it leads you straight to zero, and we really need to emphasize the absolute permanence and finality of hitting zero in finance. Think about it. If your portfolio drops by 50%, you need 100% gain just to get back to square one. It's brutal, but it's doable. But if you hit zero, game over. You are literally removed from the board. You can't compound zero. You can't trade with zero. Zero is permanent. So our entire operational framework is designed to mathematically eliminate the possibility of ever touching that number.
So, the crucial point is, how do we mathematically eliminate zero? As a narrow fitness investor, you use an impenetrable shield, and that shield is position sizing.
Position sizing is precisely defined as the exact percentage of your total portfolio that you allocate to one single investment. It's not based on how confident you feel about the asset. It has nothing to do with your gut instinct. It's a clinical, predetermined percentage boundary that you never, ever cross.
And this brilliantly illustrates the concept. Think of your portfolio as a massive ocean liner. If you build a ship as just one giant hollow hull, a single puncture from an iceberg will flood the entire vessel, and the whole thing goes down.
Right, but engineers don't build ships like that. They build watertight compartments inside the hull. So if the ship hits an iceberg and one specific compartment floods, those heavy steel doors seal completely shut. The water is entirely contained to that one small area. You lose the compartment, sure, but the rest of the ship, your overall portfolio, survives and keeps sailing. Position sizing creates those exact watertight compartments for your wealth.
Let's move to part 2, the strict 1 to 5% rule. Now, what's really interesting about this slide is how we apply a very strict, uncompromising standard to build these compartments, especially with speculative assets. As a risk-averse, clinical investor, you should generally never risk more than 1 to 5% of your total net worth on a single high-risk idea. Let's look at a standard $10,000 portfolio. If you follow this rule strictly, you're only risking $100 to $500 on that asymmetric bet. Let's play out the absolute worst-case scenario. Say that company goes completely bankrupt tomorrow. Your speculative bet drops to absolute zero. Look at the massive chunk of capital you still have left, $9,500. Your financial empire easily survives the hit, totally intact. You live to invest another day, and you do it with zero emotional panic. Now, you might be wondering, wait a minute. If you've been following this explainer series, you might spot what looks like a contradiction. Back on day 19, we talked about putting the vast majority of our money into an S&P 500 index fund. Doesn't putting 50, 60, or even 80% of my wealth into one index fund completely shatter this strict 1 to 5% rule? Let's clear that up by looking at Section 3, the core versus satellites portfolio strategy? The answer to that question is absolutely no. It doesn't break the rule at all. Let's move to and see how this builds our strategy. We have to clearly separate your core from your satellites. That 1 to 5% limitation, that applies exclusively to your speculative individual satellite positions. It does not apply to your foundational core.
Exactly. Look at this breakdown. An 80% core and a 20% allocation for satellites. Your core can safely make up 70 or 80% of your total net worth, because an instrument like an S&P 500 index fund isn't a single company. It's a basket. It's already internally diversified into 500 of the largest, most dominant companies on the planet. The watertight compartments are literally built right into the index itself.
So remember, position sizing is your mathematical shield. You absolutely must drop it on whenever you step outside of that broad, safe, internally diversified core to take calculated, aggressive shots on individual assets.
Right. It ensures that you can get wealthy if you hit the target, but you will absolutely never go broke if you miss.
Which brings us to part 4, today's action plan, auditing your ship. We are shifting from theory into immediate application right now. I want you to step into the role of Chief Risk Officer for your own wealth today. We are going to mercilessly audit your financial ship for any uncalculated risk. Step 1, identify your high-risk assets. Take a hard look at your portfolio right now. Do you have 30, 40, or maybe even 50% of your total wealth tied up in one single high-risk tech company, or maybe a single piece of illiquid real estate, or one highly volatile crypto token? Step 2, acknowledge the uncalculated risk. If you find this kind of concentration, you have to acknowledge reality. That is not an investment strategy. That is a massive, uncalculated risk. You are literally one iceberg away from total disaster. And step 3, trim it down to a safe percentage. Take some profits off the table, redistribute them back into your safe core, and demand survival from your portfolio. I'm going to leave you with this final, provocative thought as you conduct your audit today. The ultimate goal is not just to win. The goal is to survive long enough to win. Capital preservation and mathematical survival, those are the true hallmarks of a master investor. Amateurs obsess over crossing the finish line, but professionals obsess over just staying on the track. So look closely at your portfolio today. Are you building a professional ship designed to cross the ocean, or are you just holding a lottery ticket on the Titanic? We'll see you next time.